Now, even when you've built a retirement plan with solid income, smart growth, proper protection, and a clear legacy, things can still go off track. And it's usually not because people didn't plan at all. It's because they didn't plan for the right risks. The truth is, most retirees who end up struggling didn't lose money because of a single bad investment. They lost it through a combination of small, predictable roadblocks that quietly worked against them. So in this next part, we're going to look at the 4 main roadblocks that can derail even a strong retirement plan: market risk, fees, taxes, and long-term care. You'll see how each of these affects the big picture and what you can do to minimize their impact. This part isn't about fear, it's about awareness. Because once you know where the roadblocks are, you can design your plan to steer right around them. Let's start with the one everybody talks about, but few truly prepare for: market risk. We all know the market goes up and down, but when you're retired, the rules change. During your working years, volatility doesn't hurt as much because you're still contributing. But once you start taking money out, that same volatility can work against you. You're selling assets when they're down, and that's a recipe for running out of money faster. This is called sequence of returns risk. 2 retirees could earn the exact same average return, but if one hits a bad market early, they can deplete their savings years sooner. Think back to 2008 or 2020, a 30 or 40% drop in the market can take years to recover. If you're withdrawing during that time, it's like trying to fill a bucket that's leaking from the bottom. The goal isn't to avoid the market completely. It's to have a plan that doesn't depend on it for every dollar. That means building predictable income sources that keep you comfortable even when markets are down. If 100% of your retirement income depends on unpredictable market, you don't have a retirement plan, you have a hope strategy. The second roadblock is one of the quietest and most expensive parts of retirement: fees. Most investors don't realize how many layers of fees they're paying: advisory fees, fund management fees, trading costs, and sometimes 12b-1 fees built right into mutual funds. Let's put that in perspective. A $500,000 portfolio with a 1.5% total fee structure costs you $7,500 a year, whether your account grows or not. Over 20 years, that's $150,000 lost to fees alone, and that's before compounding. Even a 1% difference in fees can reduce your retirement income by hundreds of thousands of dollars over time. That's why understanding what you're paying and what value you're getting for it matters so much. There's nothing wrong with paying a fair fee for good advice, but it's got to earn its keep. You deserve to know exactly what you're paying and whether it's helping you reach your goals. If fees are the quiet erosion, taxes are the guaranteed expense that most retirees underestimate. Most people believe they'll be in a lower tax bracket in retirement. Unfortunately, that's not always true. In many cases, it's the opposite. Between Social Security, required minimum distributions, and pensions, a lot of retirees are surprised at how much their income is taxable. Let's talk about something rarely discussed: the widow's penalty. When one spouse passes away, the surviving spouse moves from a joint to a single tax bracket, meaning the same income can now be taxed at a higher rate. Then there's what I call the kiddo's penalty. If your children inherit a traditional IRA, they're now required to spend it down and pay taxes on it, typically within 10 years. That can push them into a higher tax bracket right in the middle of their peak earning years. So taxes don't stop when you retire, they just change shape. The solution is strategy, knowing when and how to take income so you can keep more of what you've earned. Strategies like Roth conversion, tax diversification, and smart withdrawal sequencing can make a massive difference in how long your money lasts. But even the best tax plan can be undone by one of the most overlooked roadblocks: long-term care. The last major roadblock is long-term care, and it's the one most people would rather not talk about. According to the U.S. Department of Health and Human Services, roughly 70% of people over the age of 65 will need some form of long-term care in their lifetime, yet most don't have a plan for it. The average cost of home care today is around $70,000 a year. Assisted living averages $80,000, and nursing care can easily exceed $120,000 a year. For couples, one event can drain years of savings. not because poor investing, but because of a health event that forces a shift in care. And here's a common misconception. Medicare does not cover long-term custodial care. It may cover rehab for a limited period, but not ongoing assistance. Planning options include hybrid insurance products, asset-based long-term care, or simply earmarking funds to self-insure. The key is to make the decision before you need that, not after. I've seen families handle this the right way, and I've seen families caught completely off guard. The difference wasn't wealth, it was preparation. Now that we've covered what can derail a retirement plan, let's talk about why some retirees thrive and why others struggle, even when they start from the same